Well, hey there, everyone. Happy Monday, May 18th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. So happy to be back here in Redmond, Washington for just a brief couple days. We're actually leaving tomorrow, which I'll tell you about in a moment, but it is a beautiful, classic spring day here in Redmond, kind of overcast, cool enough, not too hot. Can't get the plants out yet because we keep getting temperatures below 50 overnight. So hopefully they all survive while we're gone for about a week. But otherwise, hope you guys are all doing well. I had a fantastic visit to Boston last week. Spent Thursday, Friday, and then into Saturday morning there. Great to reconnect with a number of my fellow technical analysts and money manager friends in the Boston area. We had a great session at Fidelity. On Thursday, saw the Fidelity chart room, reconnected with some of the portfolio managers that I used to work with back in the day, and also some of my former teammates on the technical research team. Also then, all day Friday, had a great event, did a couple interviews, moderated a panel, gave a presentation on mindful investing, and reconnected with some really smart people from around the U.S. And Canada. Happy Victoria Day, I believe it's called. I'm making a note to learn more about Canadian holidays. My daughter's going to school in British Columbia starting in the fall, so gonna have to brush up on things like Victoria Day, which I learned about over the weekend when one of my Canadian friends mentioned today was a Canadian holiday. Here in the U.S., the markets were open. I mean, not a great day, as we'll see from the charts here in a moment, but okay. All right, let's get to the chart, shall we? As always, we've got three parts to the show. We will look at the markets and what they did today, and look at the heat map, talk about some individual group and stock themes. We will finish off with some charts that I have hand-selected for your educational benefit, I hope. Looking at the major averages, kind of mixed, right? The S&P basically unchanged. Friday, we closed the day around 7403, so just above 7,400. That was after making a new all-time high above 7,500 earlier in the week. So we finished a little bit off of there. Thursday and Friday were basically distribution days. Today, most of the day was pretty negative. We had a nice late hour surge. We were going to close pretty down pretty much for the day until that late inning surge really caused things like the Dow to move back in positive territory. Dow over the NASDAQ, the Dow not quite to 50,000, up about 1/3%. The NASDAQ leading the way lower, down 0.5%. Small caps, one of the top performing indexes as well, up about 1/3%. Volatility, even with all the choppiness and all the downward move that we saw on Thursday and Friday, still in pretty good shape. You can see that the VIX really drifted lower pretty aggressively in the last hour, right? As the S&P was surging higher, volatility came down. The VIX finishes back below 18. So it almost looked earlier in the day like we might push back above 19, getting closer to 20. Not to be. Things getting a little, things sort of settling down into the close. Rates generally not in a good place. And I mean, one of the things that I talked about with a number of my peers in the industry at the Boston event was just some of the warning signs that we're noting. And general things that were brought up, a lot of the things are things we've talked about here on the show, things like weaker breadth conditions, questionable volumes certainly came up a couple times. Higher rates, though, one of the big concerns, right? Because higher rates here, I would argue, mean concerns about inflation. And so the 10-year yield pushing above 4.6% today. Long bond yield getting around 5.15. So we're seeing the yield curve generally continuing to drift higher. The dollar was a little bit weaker today, which was actually good to see because I would argue a stronger dollar here is probably not a great thing either. But rates going higher, I mean, this is where things start to look pretty rough. And the problem with that is as the 10-year yield would go higher and higher, eventually that starts to hit people. It's just like inflation, right? Higher inflation can be okay as long as it's transitory, right? As long as it's sort of a brief, move before they settle down again. Inflation's been heating up, rates have been heating up, and that just tends to make things more expensive. Generally starts to weigh, particularly on consumer areas in the market. And that's certainly where we're seeing some generalized weakness here. So bonds selling off today and rates pushing a bit higher. On the commodity side, all of these actually finished in the green. Gold was actually chopping around the zero line for a while, and it was red earlier this afternoon as I started prepping for the show. But the GLD did finish up about 0.3%. Silver, even better. We highlighted both of those charts, I think, on last Thursday's episode. So the SLV was up another 1.3%. The energy side generally moved higher. Crude oil was really moving up aggressively in the afternoon around 3 p.m. We saw the rotation lower. Someone mentioned a Trump tweet. I was prepping for the show and wasn't looking at social media, so we'll see what that actually involved. But generally seemed to heat things up on the equity side pretty well. Cryptocurrencies kind of had a rough weekend. Bitcoin was well over 80,000, but through the course of Sunday now into Monday, Bitcoin getting weaker and weaker. It's currently down just below 77,000, although it did move higher during the equity trading session. Ethereum and the rest of the top 10 coins tracked on the stock charts platform, all in the red today. All right, just catching up on other things. I mean, the technology sector has been top of mind for so many of us for so long, and for good reason. It's still the only S&P sector to outperform the S&P since the end of March. But today, technology down. You can see the XLK was down 1.1%. I'm starting at the bottom of the page today. Industrials, consumer discretionary, and materials all below the zero line. On the upside, energy, your top performer, up almost 2%. Consumer staples, number 2, with the XLP up 1.5%. Financials and real estate both up about 1.25%. So, energy is sort of an interesting place. One of the presenters over on Friday was John Kolovis, who I used to work with at Fidelity. He was one of my analysts there. He now works for a broker called Macro Risk Advisors. And his point was, hey, if you're really nervous about conditions in the Middle East, position in energy is kind of an interesting way to play it because you're basically playing on higher crude oil prices. A small position on something like that isn't going to break you in case it doesn't work, but it would play the potential for higher crude oil prices, which arguably could weigh on other areas of the market because of inflation, et cetera, et cetera. So for now, that trade kind of working here. XLE up 2%, 1.9%, we'll call it. Breadth got better as the day progressed. You can see the breadth ratings are generally positive. In the S&P itself, 71% advancers to 28% decliners. On the New York Composite Index, a little less, but still pretty good, 59% up to 39% down. So these breadth ratings are generally pretty constructive. That's been one of the most concerning features of this market in the month of May, and it really started in April, where breadth conditions really started to deteriorate to the downside. Worth noting, by the way, the short-term model did turn negative for the medium-term, for the mid-cap index. And I don't know if that was today. I think that might have been on today's close. So something maybe to watch here. The S&P's model, which is the main one that I follow, as of Friday, bullish on all time frames. With my market misbehavior premium members, by the way, we always focus on that model in our weekly flight plan and certainly in our monthly chart review. And overall remains bullish, I think, for 5 or 6 straight weeks now on the S&P 500. Boy, the Magnificent Seven. I'm very open to other ways of thinking about this group. You may notice I finally threw in the towel and removed Netflix. Netflix, it's not personal. You were on here. You deserved a spot when streaming was the thing, and you were dominating. At one point, Netflix was the brightest of all of these leading growth names. No longer, and it's looking so much less like the rest of these charts. I finally just removed it from the list. So the Magnificent Seven and friends now down to 8 names, down from 9. Maybe I'll add something else in here at some point, but maybe there's a better acronym we can come up with. A Magmanat. I'll have to work on that. But for now, Netflix is gone. So what do we have left? Only 3 of these names were up today, and only Microsoft and Amazon were up slightly. This was not a great day for growth generally. Value outperformed growth when you look at the sort of style performance today. Tesla, the worst performer, down almost 3%. NVIDIA, Broadcom, both down over 1% today. All right, we're going to continue on in a minute. But first, I have a quiz for you. It's not a candle quiz, but it's just a question because this is a discussion that came up at the conference on Friday. And we were talking about the overconcentration in the S&P 500. We were talking particularly about the top 10 stocks and how big they are. So I ran the numbers on Friday midday, the top 10 S&P 500 stocks. If you start with the largest names, so these are like the Magnificent Seven, Alphabet, Microsoft, Meta, Amazon types of stocks. If you take the top 10 stocks in the S&P, they are about 39% of the S&P 500. That's a big number, right? But that's about where they're at. If you start at the smallest names in the S&P 500 and start adding up their weights in the S&P, how many would you have to get together to equal the same weight as the top 10? So to rephrase the question, the top 10 stocks in the S&P are worth around, weight about 39%. How many stocks starting at the smallest numbers, right? Starting at the smallest member of the S&P, how many names would you have to get together to equal that same weight? Wherever you're listening to the live stream, those of you that are watching live, drop a comment and tell me your guess. How many stocks in the S&P would equal the top 10? And it's about 39% as of Friday. I see 440 as a guess, 290. You both have picked up on the fact that it's quite a few. 147. And I'll give you a hint. It's a lot. It is an embarrassingly large number. 333, 300, 380, 333, 345. You guys are all in the 300s. That's not a bad guess. Would you believe it's about 460? It's 464. 464 stocks. The top 10 stocks are the same weight as the bottom 464 S&P 500 names. That's crazy. And talk about a concentrated benchmark. And it's sure you can look at the numbers. So what does that mean? We keep talking about the Magnificent Seven, these mega cap growth stocks, and how big of a weight they are. That tells you how absolutely dominant they are, right? I mean, it is the most concentrated this benchmark has been in decades. It literally is a mind-blowing number, if you ask me. But there you go. There's your quiz for the day. Whew. Frightening when we looked at that and all of a sudden sort of talked about it during a cocktail hour. That's what technicians do at a conference, by the way, debate over concentrated benchmarks over a cocktail. All right, we digress. Continuing on here, here's the heat map today. And as much as the major benchmarks were down, like the heat map doesn't look too bad, does it? In the upper left corner, you'll note that the technology sector looked the worst. And actually, the software area of technology did just fine, right? So if you look at Salesforce, up 3.4%. CrowdStrike, not all of these are software names. Workday, some of these charts have obviously been some of the worst charts, but they're all starting to push higher. Adobe, ServiceNow, these are all part of that software group, which has been pretty weak. And so the biggest names in the technology sector have had the worst performance today, and that's why the XLK was down. That's why it was the worst performing sector. It's Oracle, Applied Materials, Micron, SanDisk, Western Digital. These have been some of the strongest charts in the market, certainly, and definitely in the technology sector, all pulling back today. Out of the top 10 names, only Microsoft actually managed to finish in the green. Cisco as well, which is technically in the top 10 again. 2 out of the top 10 names in the technology sector were up. Everything else was down. But as you get smaller in the technology sector, it actually looks like a pretty decent day. So this is like the mega cap tech names, mostly the semiconductor names and a lot of the like the storage names. Those groups that have done the best starting to come down here. Alphabet flat for the day, Meta slightly lower, Amazon up slightly, Tesla down. Again, the reason why I led with that statistic is this is why we always talk about the Magnificent Seven. This is why we focus on the largest boxes here. And if you think about it, these boxes are not scaled correctly, right? If NVIDIA's box was actually the size of NVIDIA, it would be so big, and those top 10 stocks would be so big, the rest, you couldn't even get a pixel on some of these little boxes. So it's kind of a graduated scale. And I remember talking with the developers about some thoughts on how to kind of scale that so that you could still read some of the smaller names. So the size of this box really doesn't speak to the dominance of these names. That's why we always kind of reflect on that. So the reason why the XLK is down is because these big names were struggling. The smaller names did okay. And especially a lot of the software names, but not enough to push that sector up. What can we say elsewhere? Obviously, a lot of these sectors actually look quite strong today. Financials, which is actually really interesting to see. A lot of these charts have not been particularly, going well here as of late. But Visa, for example, making in a higher low around 320, starting to pop up a little bit to start the week. That could be an interesting area. I mean, that's a stock that's been struggling for the last for the last 12 months. It's been an underperformer and starting to push higher a little bit. MasterCard, obviously, in that same sort of payment processing group as well. So the financial sector kind of having a good day. The consumer staples sector, and that's noteworthy because a lot of the big box retailers are on their earnings list today. Home Depot, which is actually over here in consumer discretionary. Walmart, if I remember right. I'm totally Coca-Cola, which I know is not a big box retailer. I'm pretty sure that was on the list. Target's on the earnings list this week. There's a bunch of big box retailer type of names. So a number of consumer staples are on the earnings list. Those are some important charts to watch. NVIDIA's earnings, of course, which I think are Wednesday. Certainly the most dominant in terms of size and potential impact. REITs having a great day. Energy having a great day with crude oil prices going higher. On top of all of that, I would say mixed results for two important sectors: consumer discretionary and industrials. Industrials really hit or miss right now. And if you look at what happened today, it was really not as much of a sector story and more of a stock by stock basis. Some of these groups doing better. And I would say the aerospace defense names doing better than average today. Some of the big industrial conglomerates like an Eaton and Caterpillar are all pulling back a bit today. So that's an area to watch. But if you look, they're kind of a modeled appearance, some good, some bad, and a lot of things in the middle. So, we'll see. I mean, today, the general vibe Thursday, Friday into today was concerns that there wasn't a lot of progress in the Middle East. I mentioned, I think, Larry, I think you popped in there a tweet from President Trump, I guess, suggesting, to your point, suggesting he would not attack Iran tomorrow by request of Qatar and UAE. That would certainly cause a nice late inning surge. That would line up pretty well with the data. So for what it's worth, that was a concern. That's what the markets were telling you. Investors were saying not good if there's not a lot of resolution. I would argue still this is not a resolved conflict. We're continuing to just kind of kick the can down the road, but it was feeling pretty negative there for a little while. Some good news would generally cause risk assets to bounce, would generally cause rates to come down. And crude oil prices to come down, although we didn't really see that. Although bond markets closed at 3 p.m., so maybe it was a little after that when that news hit the wire. Healthcare is another one, and I was just doing a video talking about Seeking Alpha earlier today, and we highlighted 3 healthcare names, among others, that scored really well on their quant model. So I was looking very deeply at the healthcare sector a little earlier today. We'll try to highlight some of those names as the week progresses. All right, we'll get to some charts here in a moment. Before we do so, I want to give a shout out to one of our partners, Seeking Alpha. And we're particularly going to talk today about their Alpha Picks product. If you're looking for high quality stock ideas, but you don't have time to dig through thousands of charts and reports, this is worth a look. Alpha Picks from Seeking Alpha delivers 2 data-driven stock ideas every month, selected from their top-rated strong buy universe using a proven quant model. They actually just released their second pick for May, and you can review that latest selection along with some other recent picks at marketmisbehavior.com/alpha picks. It's a simple, systematic way to follow a rules-based approach to stock selection with full transparency into the process behind the picks. Check it out today at marketmisbehavior.com/alpha picks. They are offering my viewers 10% off a new account. I would encourage you to check it out. And thanks again, Seeking Alpha friends, for being friends to Market Misbehavior. All right, let's look at some charts, shall we? I had mentioned on the show last week sort of the anecdotal evidence that we had in the Fidelity chart room. And again, it was so awesome to be back in that space. It was once called the Cathedral of Charts by legendary technical analyst Walter Deemer. It's just a fantastic visual representation of market history through the lens of charting and technical analysis. I share the anecdotal story of how when the market would keep going up, we would have to print out new paper charts and adjust the scale down because the market was literally going through the roof of the chart room. And I learned that the signal wasn't when we had to print out new charts. The signal was when we didn't have to print out new charts anymore, because that meant the uptrend was no longer happening. I've had to bump up the shaded area on my daily S&P chart until last Friday, and I didn't have to do it again. That makes me a bit concerned, I would say, right? I mean, what I'd mentioned was, hey, I'll let you know when I don't have to print out new charts, and I've not had it to adjust the scale since Thursday of last week, and that's when we closed right above 7,500 for the first time in history. Looking at the daily chart of the S&P 500, we can see that Friday's drop today at one point looked a lot weaker. We had that nice rally in the last hour, but still we're seeing initial signs of distribution. The RSI no longer overbought. Is this still an uptrend? I would say undeniably so. Our market trend model remains bullish on all time frames. Are the moving averages still going up? They definitely are. We're still above the upward sloping 21-day EMA. All of them are going higher. At some point, this market most likely breaks an initial moving average, and we have to talk about a potential drawdown. But for now, we're still making higher highs and higher lows. And so I would say the structure is pretty good. We're kind of watching that 21-day EMA as an initial level of potential support. We've highlighted recently the expansion in new lows, which is one of the more concerning developments that we noted. And through mid last week, which is the last time we did a live show, we had less and less new 52-week highs, more and more new 52-week lows. Over the last couple sessions, we actually had less new lows. So those names, it's like a lot of those software names that bounce today, right? These are charts that have been going down for a while, all started to pop up a little bit. And so less new lows, that's a good sign. We're not really seeing a ton of new 52-week highs right now. Things sort of settling down and waiting as we wait to see which way this resolves. But I would say a little less pressure on the downside because we've had so many names making new 52-week lows, little less. The VIX opened just above 19, and I checked a little after the open and thought, ooh, maybe this is that day where we start to power above 20. Wasn't to happen. Again, that late day drop in the VIX was marked, it's happened at the same point that the S&P and the NASDAQ were rallying into the close. And so the VIX coming off here, ending the day back below 18. That was after closing above 18 on Friday's session. So snatching victory from the jaws of defeat, as it were. VIX very close to pushing above 20, staying the execution for another day. The volatility has remained very, very low. This has been a nice low volatility uptrend over the last 4 weeks. At some point, the VIX is going to pop above 20. For me, that's going to be a warning sign that we're starting to see signs of instability, which are often marked during a downside rotation. Volatility remaining low enough for now, which is good. Rates not giving us good vibes. We saw this spike higher in the 10-year Treasury yield. That was on Thursday's session, and today even further. So higher rates are basically the market, pricing in higher inflationary pressures. The inflation data we saw last week was pretty high. Obviously, this is connected in very much to the events in the Middle East. And even though we got some good news at the end of the day, bonds sold off again today as investors are wary of a protracted, issue in the Middle East. And the longer that even stays at its current levels, the longer we have that disruption, I would generally assume that puts upside pressure on interest rates. And if you look at the chart of the 10-year Treasury yield from the end of February, barring some brief pullback in early April, this has been a pretty big rising rate type of environment. At some point, as rates go higher and higher, that really starts to weigh on consumer behavior. Anything you need to borrow money for starts to become more and more expensive, tends to hit home builders and consumer names in particular. Here's a chart of Bitcoin. I just want to point out, we talked last week how it's in moving average limbo because it's below the 200-day and still above the 50-day. Over the last couple sessions, we've seen lower lows every session since last Wednesday. And right now, it looks like the 50-day moving average is in play. I'm also just looking from the end of March, this rally up to early May, excuse me. If you look at 38.2% of the way down, is right around 76,000. That was today's intraday low. That's right at the 50-day moving average. This is kind of a confluence of short-term support. I would say a bounce around here, still pretty stable. A break below 76, really break below 75 to complete that downside move would indicate that this uptrend move off of the March low is probably over for now. We're expecting further deterioration. So right at a key level of support for the chart of Bitcoin, something we'll be watching closely. We highlighted Broadcom last week. I just wanted to point out no real change on Friday and then today's session. We're showing a bearish momentum divergence with higher highs in price and weaker peaks in the RSI. It's a general, often a topping sign when the market keeps going higher, but the momentum starts to wane. Still okay because we're still holding the 21-day EMA, but it is very much actively being tested here to start the week. So I think we watch that. Breakdown there would certainly be a change of character potentially on that chart. Palantir is still okay. This is the level we're looking at, around 125 to 130. That's where we bottomed out in February. That's where we had this great hammer candle in April, kind of right back to that range. A breakdown below 125, that's where I have a price alert set. That would be a really negative move for Palantir. Other software names have been recovering pretty well. Palantir still just kind of generally drifting lower, and the moving averages all going down as well. Newmont Mining, I would argue, is big time neutral. It gapped lower on Friday, kind of held that gap on today's session. We're in a really narrow range here. If you look between 120 on the upper end and probably 107, we'll call it, on the lower end. For me, this is one of those where the chart is just not showing strength. At best, it's sideways. At worst, we potentially break down, but I'm not really seeing anything bullish on this particular setup here. However, a break above 120 would be a really bullish follow through. So this is one of those where I'm happy just kind of being patient, setting an alert for 120, and then just going on to other charts. And if it hits the trigger, and if NEM breaks above 120, then I know to revisit the chart. Otherwise, I'm happy looking to other names. Also look at the momentum, which is just dead even, right around 50. It's really hovering between 40 and 60. We want to see a momentum break to the upside. RSI above 60 is a good thing to look for there as well. All right, NextEra Energy is a stock that actually gapped lower today. I'd set a price alert, I think, last week for that 90 level. This was a pretty well-tested level of support from February, March, and April, right around that point. Today, we gapped lower and just popped right below that point. So tomorrow, do we get downside follow-through? I would say the fact that we broke down is not good. The fact that the RSI broke below 40 is not good. The relative strength has been absolutely negative since the end of March. So not a lot of things to look good on. I would say tomorrow, do we get any sort of bounce higher, some sort of whipsaw? That would then be a lot less negative. But for now, I would say this is guilty until proven innocent. CrowdStrike, let's finish with a strong chart getting stronger, right? When you look at those software charts that look so bad, the narrative on CrowdStrike was, look, AI is killing all software names. The group is dead. These charts are going down and they're not going to stop. I generally agree with that assessment as long as the chart keeps going lower. But the chart of CrowdStrike shows you how it can recover. And if you look at what happened with the chart of CrowdStrike, it started with some higher lows here in late March and early April. Then we had this consolidation where you probably label a bull flag pattern right at the 200-day moving average. This is why I always highlight stocks making new 3-month highs. This is why I look for stocks breaking above the 200-day. This is where I look for confirmation with the RSI pushing above 60. All that happened the first week in May. From there, the stock has lit up. The breakout was right around 470. We're currently sitting around $618 a share today. It's up another 4%. So for me, right, it's not about predicting the future. We don't have to know that CrowdStrike is going to go up so much. We just have to watch the chart and look for signs of accumulation. Look for a breakout with improving momentum. Look for a stock that's able to finally recover above a key moving average. Charts can get better. They start with that initial breakout. So breakouts can often work. Follow the charts. Look for the signs of accumulation. All right, let me take a question here. 3P Investor, I love this comment earlier. I just wanted to come back to it. You said, OMG, just imagine what a mild tremor in the top 10 will do to the market. 100%. And that is what you have to remember, right? And that's why breadth is important. Don't get me wrong. Breadth is important because that it tells you the conditions on the individual stocks, but what happens to those biggest names is vital. That's why, as part of the show, we always review the Magnificent Seven. The performance of those names matters more than you probably would imagine if you're just looking at stocks. This is not a market of stocks at the moment. It's a market of a relatively small number of incredibly important names and also a bunch of other stocks. And the good news, someone mentioned it's a stock picker's market. I would wholeheartedly agree. The great news is there are good charts outside of that space. And I think this is a really good time to be sort of going through and reviewing which charts are showing signs of strength, because that's where we can certainly find some great opportunities. Folks, seeing no further questions, let's wrap up the show. Thanks so much for tuning in today. Excuse me. Those of you tuning in live, I appreciate it. Those of you watching the replay on our YouTube channel, hey, take a moment and drop a question on our YouTube channel. Just to give you a quick update, this is going to be a weird week. My daughter is graduating from high school. That only happens once, and it's happening in Michigan. I'm in Washington State, which means I need to get my family and a bunch of other extended family members all to northern Michigan so we can watch my daughter graduate. No more live shows for the rest of the week. I will keep you updated when I can. For my premium members, have no fear. I'll be focusing there. When I have time to review the markets and share some insights, I'll be doing it there. Great time to become a premium member if you want to keep in touch with what I'm thinking. You can find more info at marketmisbehavior.com/premium. Otherwise, I'll be putting on some random videos on the YouTube channel. We'll be back live next week, Memorial Day week. In the meantime, have an awesome, joyful week. Wish you the best. And remember, it's always a good time to own good charts. Take care, folks.